I'm going to show you a couple of things here. First of all, we're going to put this thing in here at 4%, $350,000 mortgage. And, if people said, listen, at 4%, you mean I missed that 2.9% window? Got a mortgage at 2.9 if I had hurried? Don't worry about it. Do not worry about the fact that you didn't get that 2.9. In fact, you might want to say, thank you. I missed the 2.9 and the interest rates were able to rise a little bit. Watch what happens here. We're going to go over how to understand how an amortization schedule works here in just a second. So first of all, we're going to take a look at the summary. And in the summary, we are able to see, folks, that on this $350,000 mortgage, the bank wants you to pay $251,542 in interest on a $350,000 loan. Folks, does that look like 4% to you? Oh, no. It is actually, if you look over here to the left, you'll see that it is actually 71%. And so we find out that the interest that the bank wants us to pay is 71% of what you borrowed. Let me break that down just a little bit more. If your loan was just $100,000, your mortgage was just $100,000 for 30 years at 4%, the bank would want $71,869 in interest from you on a $100,000 loan at 4%. That's what amortization does to a loan. And guess what? You do not have to abide by that. That's if you use the bank's timing. You see, the bank's timing is based on a 30-day cycle. Every single month, they get to charge you all of that interest when you make a payment. But what if you disrupt their timing and give them money when it makes it impossible for them to charge you interest? Yes, you can do that. And then the exact amount of interest that they would have charged you, you can save. You can save at the exact same rate that they're charging you. This is why you want to make sure, listen to this now, you want to make sure you control your principal payments. You want to have the principal payments where you need them so that you can take advantage of this amortization schedule. We're going to get back to that in just a second. So we're going to scroll down here and see that at 4% on this loan, your principal payment is $504.28. And look, your interest is $1,166.67. Oh my goodness, that is a lot of money. All right. And so if we subtract the $504.28 from what we owe, we're left with $349,495.72. That is our new principal balance on line one. So the bank takes the principal balance every month, does their math, and then comes up with how much interest is owed on line two. Well, because you owe less, you're going to pay less interest. And your interest cost on line two goes all the way down to $1,164.99 instead of $1,166.67. Not much difference at all. That's still a lot of money. In other words, out of the payment you're making on this loan, only a little over $500 goes to the loan. Over $1,100 goes to the bank, charging you interest just to be able to pay your loan down by $500. Folks, this system that we're looking at right here is 88 years old this year. We've been doing this, and for 88 years, we have not been taught how this works in school. I have never talked to anyone who says, I learned this in junior high. I learned this in high school. I learned this in college. No, but we're all expected to use this lending system using credit cards when we buy a car, when we purchase a home, when we do all of these things. It is about time we stop letting the banking system take advantage of us only because we don't know the rules to the game. So already You feel like something is off here because they can call this a 4% loan, but I end up paying back 71% of what I borrowed. Already something is off. Already something is off. If only $500 of my payment goes to the loan and $1,166 goes to the bank. At this point, I'm buying one house for me and 3 for the bank. That's almost 3 times, 2.5 times what I'm getting. Listen, when are we going to stop letting the bank take advantage of us here? All we need to know is how to read this chart. Do you know it was illegal some time ago? It was illegal to teach slaves how to read. And why was that? Because if the slaves learned how to read, then somebody would have found a book on military tactics, band together, and slavery would have ended long before 1863, let me tell you. Okay? We'd have another celebration other than Juneteenth. We'd be calling it something else. So here's what we need to do, folks. The Bible says that the borrower is slave to the lender. The borrower is slave to the lender. And why? Because we don't know how to read this chart. Once we learn how to read this chart, oh my goodness, how things change, not just for you, but for your family, for your children, and for your children's children. You'll be able to pass this down so we can get rid of all of what you heard about how this works and learn it for yourself how it really works.
But Don has some valuable information that can contribute to the quality of a person's life. And it only costs you a few dollars. It's his book. Why not get that?
I'm going to go through the P.I.L.L method myself with some of my investment properties. So I'm going to link up with Don, and then I'm going to sit down with him, show him my investment portfolio, and see how I can eliminate interest.